In this video, we're going to talk about cost volume profit relationships, and more specifically how break-even part can be derived from that. So from a graphical perspective, we can also analyze this. If we allow dollars to be on the y-axis and activity to be on the x-axis, I can I can provide the graph here for total fixed costs, where whether we make 0 units or we make X, whatever this represents, so many units, total fixed cost stays the same. We can also include in this graph the total variable cost, so that at point 0 I incur a total variable cost of 0, but as I increase production, total variable cost increase. If I take total fixed cost and total variable cost, I can also come up with a line that represents total cost. And that line would have to start here at the y-intercept or the fixed cost point. And then any further production from there increases total cost at the same slope as the variable cost. So if this is our total cost line, if we include a total revenue cost line somewhere around here, we can see that at some point total revenue, the dashed line, will exceed total cost, this solid line here. And this point right here we refer to as the break-even point. This is where total cost, whatever this level of activity is, this is where total cost equals total revenues, and hence our break-even point. And then lastly, we can incorporate a profit line, total profit line, where this line should intersect the x-axis at the same point as the break-even point. So any amount or any activity above the break-even point gives us profit. And that same, if we were to calculate the distance between this line and 0, that should be the same amount between the dashed line here for total revenue and total cost. Now this is not drawn to scale, so it doesn't it's not going to come out perfectly, but that's just to get the idea. And then any amount, any activity below this point obviously is the loss, and the loss is the difference between these two. An easy way to think about the break-even point is to also think about it algebraically. There is a formula for break-even point that you can memorize, which is break-even point equals total fixed cost divided by contribution margin per unit. Or you can simply use your intuition to solve this. If we take this common formula here, where total revenue minus total cost gives us profit, we can derive at this break-even point formula. So allow profit to be 0 for the break-even point, and we have total revenue minus total cost equals 0. Allow R times X to equals total revenue, and allow variable cost times X and total fixed cost to be the total cost. So I'm just restating this formula in variable form. So this will say where R equals the revenue per unit, VC equals the variable cost per unit, and X is the number of units sold. If I solve for this, if I take total fixed cost to the other side of the equation, then I end up with this right here. And if I factor out the X, I end up with X times R minus VC, which if you divide by R minus VC on this side and R minus VC on that side, you end up with this, the break-even formula as total fixed cost divided by contribution margin per unit, which is the same formula that you can memorize, but just so you understand that it's really an easy to derive type formula.